Thank you guys for joining. For anyone who went back to back, we just did one of these at 12. Anyway, we'll see if we can do a better job on this one. This time I don't have Doug with me, so I have to speak on my own. But my name is Mark Lamonic. I'm the product manager for Morningstar Premium and morningstar.com.au. Today we're going to talk about our Active Passive Barometer report in terms of selecting funds and ETFs. So hopefully it will be an interesting topic. So a couple of housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice for our friends in New Zealand. You can find our FAP on morningstar.com.au. And you should go consult with a financial advisor if you have any specific questions or you want some personal advice. Also, if you could ask questions, that would make me happy. So any questions you want to ask about anything, send them through, and I'll get to those. And yeah, you can send them through the Q&A button or the chat function. And this thing will be recorded. We'll put it on YouTube and also on our website. And if people have questions, they can email me at mark.lamonica1@morningstar.com. All right, so time to get going. So this is our 101st webinar. We had our 100th on Thursday, which was exciting. I was just saying to Will and Shawnee that now we have to do literally 100 more of these before we get to a good milestone number, which is depressing. But yeah, we hit a milestone on our podcast as well when we went out for Korean barbecue on Friday, which I thought was fun. It involved Korean barbecue, bowling. Shawnee and I had our tarot cards read, and Will went out afterwards with his mates for one of their birthdays, and one of us did not get out of bed on Saturday. Yeah, it was Will. That's the answer. Anyway, let's get started. So I want to talk a little bit about the Active Passive Barometer report today, because that's sort of what we're centering this around. But first, I want to talk a little bit about funds and ETFs in general. So why don't we start with the PowerPoint before we get into the report. Okay, so let's talk, and you've probably seen this slide before, but we'll get to the report quickly. So yeah, what we're talking about is how can you figure out which funds and ETFs to select for your portfolio. We just have this sort of placeholder slide here saying what you shouldn't be doing is chasing returns. That is what most people do. Most people spend their time chasing returns, and that does not work out very well. So we have a separate survey that we could do a whole separate second study that we could do a whole separate webinar on called the Mind the Gap study, which basically looks at the difference between investor returns and investment returns. And of course, what we do is we call that the gap, because investors chase returns. The returns on underlying instruments is higher than the returns that investors actually get on it. That's because we're chasing performance and there is reversion to the mean. So that is what not to do. Now let's get into the Active Passive Barometer report and what you can use it for. So first, a little overview of what it is. So the Active Passive Barometer report is a report that we do every 6 months. And what we're looking at is we're looking at across different funds and ETFs. We are looking at active managers versus passive managers. So once again, the difference is passive manager is following an index. Now, there are some interesting intersections between this, but they're following an index as in they are not making decisions on what securities to actually buy. They will change the portfolio if the index changes. So a lot of indexes are indexes like the ASX 200, which is a market capitalization weighted index. It shows the top 200 shares, top 200 companies, 200 companies in Australia that are the biggest, the 200 biggest. So obviously, if companies change in size, and that company is, the size of a company is judged by market cap, so shares times the price, shares outstanding times the price. If that changes, then the index will change, then the actual underlying investment will change. So that is a passive fund versus active, where someone or something is making decisions actively to decide what's in the portfolio. So the classic one, of course, is just that there's a portfolio manager that's making decisions on what to buy or sell. We also now have a lot of quantitative funds that are looking at like factor profiles and stuff like that, where based on basically computers are making decisions based on algorithms. But either way, somebody or something is making a decision on what to put into that portfolio. So what this report looks at across all different asset classes, have active managers outperformed? And we've heard a lot, and this is really sort of the John Bogle Vanguard view of the world, that active management is not worth it. And basically the theory behind that goes is that when you start including fees, which are significantly higher for active funds and passive funds, when you start including fees, virtually nobody beats the market. So none of these active managers are beating the market. So instead, the smartest thing to do is obviously just invest passively. Now, our Active Passive Barometer report in some ways confirms that, and in some ways refutes that, depending upon the asset class. So let's look at it. If anyone wants a copy of it, okay, now I gotta find it. If anyone wants a copy of it, just let me know. Email me, I will send it to you. One important thing to note that this is a US report, but the same conclusions apply anywhere. And we'll get into what those are. All right, so this is our latest report in March of 2021. So you can tell that this thing, well, maybe you can tell, the thing's long. So there's a lot of stuff in this report, which is good. But the main thing that we want to look at is this chart right here, which is probably small. Let's see if I'm smart enough to blow this up a little bit. All right. This is what I was just talking about. So what are we looking at here? We're looking at active fund success rate by category. So what we're looking at is all of these different categories. Now remember that this is US. So in here, when it says foreign large blend, that means not US. So just think about how we would look at this from an Australia perspective. The one thing that I will say is the US market and the Australian market is pretty similar in terms of there are a lot of investors that are interested. There are a lot of active managers, a lot of active investors. It is followed quite closely. So the conclusions are basically parallel. All right, so let's look at what we're saying here. We are looking at the active manager's success rate. So that means after fees, are the active managers able to outperform their passive counterparts? And we're looking at 1-year periods all the way up to 20-year periods. But what we highlight here is a 10-year period. All right, so in this 10-year period, we are looking at lower cost funds and higher cost funds. So a little caveat for that. Since John Bogle came out with originally his view and wrote his book and everything else around active and passive funds, fee levels have significantly come down for active funds. And basically just because the market's not paying it anymore. So those fees have reduced over time. So what we're doing is we're dividing up that universe into quintiles of funds and looking at the cheapest ones and looking at the highest cost ones. Highest cost ones all do very poorly, and that's because it is very difficult to actually beat that passive counterpart when you're already in the hole a couple percent for fees. So that's one thing to think about. The other thing is that as an investor, I kind of concentrate on these lowest cost funds. So we should all know that if we're investing actively or passively, fees matter, so look at fees. So this is really the data, this column right here that I'm looking at. So what you can see here is depending upon the asset class, the active managers are more or less likely to beat that underlying index. So you see for a low here, we've got 17.2% in US large blend. So what that means is US large cap stocks that can invest both value and growth stocks. Then from a high, we get up here to 62.5% for US real estate and a number that are above 50. So what does that mean? That means most active managers in this low cost category, most active managers are outperforming the benchmark. So as investors, what do we do with this? Well, we can inform decisions that we make versus buying active or passive funds based on each one of these categories. Now, how does this actually play into decisions that we're making as investors? Well, a lot of people, and this is sort of the Bogle view of the world, a lot of people think that you have to be an active proponent or a proponent of active or a proponent of passive. That's not true. When we look at our portfolios, there's lots of different decisions we can make about which instruments and which types of investing we're going to use for different parts of our portfolio. So you can have active funds and passive funds. There's nothing wrong with that. Just like you can have ETFs and funds in different parts of your portfolio. You can have individual shares in certain parts of your portfolio. All we are proponents of, and all we're saying here at Morningstar, is that you need to take a step back and think about and deliberately pick investments that are going to help you achieve your goals and that apply to your own personal circumstances. So as much as we always keep saying this, this little mantra that, and it is a regulatory requirement that we can only offer general advice, it really is very, very difficult to offer anybody any sort of guidance on what instruments to use or investments to make if you don't know anything about them. And it's one of the problems that we're going to talk about on a podcast episode later. One of the problems that Shani and I have with robo-advice, that sort of these one-size-fits-all approaches to investing don't really work. Okay, so let's talk about some of the differences and why we believe active managers outperform passive managers in some categories and vice versa in the others. So let's talk about reasons, and I have a slide for this. This is an exciting one where I go back and forth. New share. Jeez, what is that? Okay. Was I still on that? Did I never share the report? Okay, but now I've shared the other thing. Sorry. Anyway, let's talk about the reasons why different categories, why we believe different categories are areas where an active manager can outperform passive. Okay, so let's start with efficiency of the market. So what does efficiency of the market mean? It basically means it's basically a proxy for how much the market, how much securities in that market reflect the underlying values of the companies in that market. So this goes with the whole notion that we believe very strongly at Morningstar that there are times when markets are more or less efficient depending upon, sorry, I had to figure out what I'm saying. Okay, too many webinars in a row. I'll pull it together now. Okay, so what we are actually saying here is we are saying that there are situations where there can be a large difference between the price of something and the value of something. And that this difference can vary on markets. So when we say efficiency of the market, that is a proxy for how much that price represents value. Now, why is this different in different markets? Well, there's all sorts of reasons. One reason it's different is because the more investors that you have that concentrate on a certain market, the more efficient it should be. Because you have more people looking at something, if something becomes a little bit out of whack in terms of price and value, you would expect that to correct as people go out there and buy things that are not, that they believe are cheaper than what they should be. So the more people they're looking at, theory, the more efficient it is. If everyone is ignoring a market or very few people are involved in it, then we can see periods where that difference between price and value actually gets larger. So let's use some examples here. We'll go back to this Active Passive Barometer report. So we're going to look at two different things. Let's look at U.S. large blend. So 17.5% outperform that, active managers outperform. That's really, really bad. Let's look at diversified emerging markets. How about that? No, we'll use an easier one. Let's look at U.S. small caps. So small cap growth. Now, why is there a difference between these two? Well, one reason there could be a difference between this is more investors are paying attention to larger stocks. They're the ones that, of course, you hear about. They're the ones that many investors have a structural reason that they have to invest in. So that means that more people are concentrating on it and it's more efficient. Now, let me talk about the structural thing. As individual investors, we don't really have to worry about that, which is a huge advantage we have. But if you are a large institutional investor, there are some companies that are basically too small for you to buy because they aren't big enough that you can actually take a position in those companies that's meaningful for your overall portfolio. So a lot of big investors have to ignore certain things. They have to ignore certain parts of the fixed interest market. They have to ignore small caps. They have to potentially ignore emerging markets if, once again, a lot of those are a lot smaller. So in markets where more people do not pay attention, it can be less efficient. In a less efficient market, a professional manager that's managing money should be able to outperform. So we are using these figures right here as proxies of how efficient a market is. So that's the first thing we're looking at. The other thing, of course, is that when you are looking at making decisions between active and passive, as we saw on those other two columns, is the fees. What is the hurdle that the active manager has to overcome, has to outperform in order to make a positive return? That's why we see that split between low cost and high cost. Check the fees of the funds. It's going to have a huge impact on the returns. Representative, geez, I've never noticed, I've used a slide before that I can't write. That should say of the index, not how representative is the index. Oh, no, you can say is the index. Wow, I'm losing it today. Okay, so what does that mean? So that basically means what is the pool of securities that a manager can go in there and select from, or that the index makes up, versus what a manager can select from. So the simple example of this is always fixed interest. So for fixed interest, for equities, it's pretty set, right? At the end of the day. For fixed interest, it's not, because the index represents a very, very small part of the investable universe. So a simple example of this is even if I am going out and I'm buying large corporate bonds. So the index will generally only be a certain amount of corporations that is representative of what the index provider thinks is the market. But there can be all sorts of different bonds I can buy as a manager. I can buy ones that started 10 years ago that have 10 years left. I can buy on-the-run bonds that have just been released by a manager. I can play around with credit quality a little bit, who's more or less likely to pay back. Even within investment grade bonds, there are 5 or 6 different selections of credit quality I can play in. I can go out different amounts on the yield curve. So am I doing long duration bonds or short duration bonds? The point is that there's a lot of different choices that I have as a manager, and the index is not that representative, meaning it's more likely I'd be able to outperform. How liquid are the assets? This is a problem for passive investing, particularly in the same cases I'm talking about, small cap stocks, fixed interest. What does this mean? It means liquidity is how many buyers and sellers there are in a certain security. So if you are buying a large cap US stock, it's very, very liquid, meaning that it's easy for me, even as an institutional investor, to build a position. So if I am a passive manager and a new company enters into the S&P 500, it is pretty easy for me to go out there and fill my position. Now, it's a lot harder if it's a small cap stock, because the problem is if I'm a big index provider and I'm a passive investor, I can move the market. So what that means is that I'm going to get tracking error. It means that this position could potentially run away from me as I'm trying to fill it up, and I have an obligation to fill that position. Whereas as an active manager, I can be a little more strategic in my trading, and I can take things into account, like how liquid is a certain security, which means I can slowly fill my order over time, which means I can do all sorts of things where I'm not contractually obligated to just simply copy the index. And when one thing comes out, one thing goes the other. I don't have to immediately sell everything and immediately buy everything if I'm an active manager. All right, so those are some of the factors that we're going to look at. We've got a couple more slides to go through, but we do have some questions. Okay, so Justin's asking a question. What are the pros and cons of a Australian equity ETF over a global equity ETF? How does your answer change if comparing Australian versus global bond ETFs? Okay, let's... So I think for both of these, we have similar answers. Okay, so let's think about what you're doing when you're investing in Australia versus global. Okay, so the Australian market, if you are investing in an equity ETF, we're going to assume that it's passive. I'm assuming in both cases here that we're talking about passive investments. The Australian market is, of course, very much dominated by certain industries, namely banking and resource companies. So if you go and you look at the ASX, about 50% of it, ASX 200, about 50% of it is banks and miners. at the end of the day. That is not really replicated anywhere else in the world. So Australia, because of, number one, obviously the natural resources that are here. Number two, because of sort of the, I guess, toleration of kind of a near monopoly standpoint from a banking or divided up into four, but a pretty concentrated banking industry that isn't really tolerated in other countries. You have a couple companies that make up a lot of the index. So what does that mean? It means that if you're investing in Australia, there are different profiles, and they're pretty pronounced, between banking and resource companies versus other industries. What are you mainly missing in Australia? Given sort of looking at global indices, you're missing tech. Now, you could argue also that if you go and you look at the US market, that it is dominated by tech and increasingly dominated by tech. But the point is that if you're an investor, these are very different profiles of companies. So yeah, just know that if you're investing in Australia, you're very much concentrated in certain industries. Overseas, there is more diversity of industries, but also if you start looking at the US especially, very, very dominated by tech. And then even things that are not in the tech sector that we would all consider tech, Google, Facebook, et cetera, stuff that's communication services. The other thing I'd say in Australia, and I know the stats in front of you, you are very much looking at overall domestically focused companies. So a lot of Australian companies, if we measure this by revenue in the ASX 200, it's much higher. The percentage of domestic revenue in Australia is much higher than it is globally. So US is much more globally diversified in terms of companies and US indexes. If you head over to the UK, it's even more and more and more globally diversified. So you do have a lot of home bias investing in Australia. So home bias is the fact that investors do like to concentrate on things that they know. So in portfolios, not Australian portfolios, just everywhere around the world, people do invest a lot more in domestic companies because they know them, they understand them. The home bias in Australia is exacerbated by the fact that many of the companies have home biases, and that they get a higher percentage of their revenue in Australia than other countries. So those are a couple of things to think about. If we look at bond ETFs, which was Justin, your second question, same kind of thing. That there just is not as deep of a fixed interest market in Australia as there is globally in terms of the types of bonds that are issued, and certainly the breadth of the market. So yeah, a couple of things to think about, and obviously in both cases. When you're looking at Australian versus global, you have to take currency into account. So if you are a domestic investor in Australia and you're investing overseas, you want the Aussie dollar to get weaker. So remember that. That adds to returns. So it's an important consideration. All right, so Joan's asking a question, does active versus passive funds by asset class change over time? For example, are active managers better in a bear market? So really, really good question. The active managers would like you to think so. So the argument that you always get from active managers is that it's fine when markets are rising to invest passively, but when the proverbial what hits the fan, that is the time when that's the time when active investing can outperform. So yeah, something to think about. We've looked back on this, and I think a lot of this is probably marketing spin. So we haven't really seen the data bear this out. One thing that I would think about is we have never seen passive be such a large part of the market. So when we do go back and look at that data, coming out of the GFC, about 25% of US assets were passively invested. We're close to 50% now. So there are people out there saying, and I don't know what the answer is to this or anything else is, there are people saying that, quote unquote, this time is different because the market is so dominated by passive that if we start seeing selling, sort of indiscriminate selling into passive, that's going to drag down the big components the largest companies in the world. Just as we saw the largest companies in the world outperform and make up more and more of indexes, the opposite will happen when people start selling. So that is something to think about, Joan. The problem is with active managers, they like to paint this picture that they are somehow doing something different than the market, but a lot of them aren't. So a lot of them are either closet indexers or very, very concerned with indexes and realize they're smart enough people to realize that sort of mathematically, if they're not investing in these large cap stocks, there are going to be large differences between their returns and passive returns, good or bad. But to actually have the guts to do something very different, a lot of those managers just don't have it because of career risk and other things. So Chris is asking, does a barometer report cover Australian market analysis? Is it based on historical data and therefore are you still required to have a holistic approach analysis when choosing to which product equity to invest? Yeah, so it does not. So the report that I just showed does cover the US market. What I'm trying to say is that I think a lot of the conclusions that you get out of the report would also apply to the Aussie market. So yeah, it is historic data. Right? It is historic data. That is the problem with all of this, right? Anything that you're looking at, any information you look at about a company, any return data is historic data. Things can change. And a good example of this is, historically small cap value has been the place you want to be. This sort of 3-factor model of looking at returns. So small cap value is how you get high returns. That's historic. You go back and look at 2008 on, none of that happened. Large cap growth. So yeah, there is things can change. That doesn't mean that's a permanent change, but just know that. All right. So okay, Glenn is asking. So Glenn's saying, what percentage rate would you label low cost active managed fund? All right. So what we're saying is we are looking at deciles here. So low cost is the 10% cheapest active funds. So looking at all the funds, those are the 10% that are cheapest. And then high cost is the 10% that are most expensive. So thank you for the question, Glenn. So Justin's saying there's a simple and logical cost-effective strategy promoted by some that investor just needs 2 low-cost ETFs, global diversified equity ETF and a diversified bond ETF. Allocation depends on risk profile. Is this strategy so simple and logical? Why don't more people do this? It's a really interesting question. Yeah. So what a lot of people are saying is just buy the market. That's what you should do as an investor. Buy the whole market. So you can certainly buy the whole market in a single ETF, equity, and bond. So yeah, I probably think that if you want to invest passively, if that actually fits into your strategy, that it's not a terrible approach at the end of the day. So why don't more people do this? More people probably don't do this. More people probably don't do it because there's a lot of people in the financial services industries telling you not to. So I could come up with all sorts of reasons why you shouldn't do this, but if you're not going to spend a lot of your time worrying about investing, then you just do the simple things, right? Low cost, rebalance, follow the market, like in passive investing. So yeah, there are a lot worse things to do. So hopefully that kind of answered the question. It was funny, we're recording a podcast after this, which hopefully I'll be less brain dead for. But we started looking at a lot of these platforms, right? So when you think about investing, there are products, which is what we mainly talk about. What are ETFs or funds or everything else? And then there's platforms. There's how you access those products. And I spent too much of my time last night looking at Raise. So Raise is a platform, and I was looking into sort of their investment approach, and it is wacky. The just gibberish that they are throwing at you, which is supposed to be this active, just this passive way to approach the market, their portfolios. I'm sure there's a lot of justification for what they've decided to do. They don't explain any of it. But yeah, they have very crazy portfolios. You think you're just investing in passive ETFs. You're not. You're making huge bets. They have, and I use Raise. I don't know why, but just it's a very small part of my net worth, and I like the fact that they like do roundups. But anyway, enough about me. I was looking at, I'm in their aggressive portfolio. Once again, I don't pay attention to this because it's insignificant to my net worth. But I've been looking at their aggressive portfolio last night, and yeah, they have 5% allocated to the US. Where if you look at, as you were saying, Justin, if you look at a global equity ETF, passive ETF, 65% is allocated to the US. So they're making huge bets. And whether that plays off or not, or plays out or not, I don't know. But yeah, it's stuff like that where you would sit there and say, okay, if you're investing passively, I'd rather take Justin's approach. All right, so really good question by Carrie, and now we're going to get a little philosophical. So Carrie says, do you think active fund managers' days are numbered when more people are investing in ETFs? Okay, so let's separate two different things. There are active ETFs. Now, most ETFs are passive right now, but a bunch of managers are starting to release more and more active ETFs. So Magellan famously has basically done this across all of their strategies. That anything that Magellan Global, Magellan Infrastructure, all the different strategies that they have, now you can get it in a fund and you can get it in an ETF. So yeah, let's just make sure that we're not denoting all ETFs to passive. Most are passive. Do I think active managers' days are numbered? Well, a lot of people are worried about what would happen if that's true. So one of the things that Bogle didn't talk a lot about is that passive managers, the point of, if you are investing passively, you're assuming that the market's pretty efficient. This whole process that I've been talking about, where there are a bunch of people looking at the market, and as there's a difference between price and value, everyone will pounce when they think something's a little cheaper. And remember, the market, the index return is the average. It is the average viewpoint of what everyone thinks. So remember that. Now, what happens if there's no active managers? Then what happens, right? Then as less and less active managers are in the market, the passive investors are really piggybacking on all of these different people trying to beat the market. And they're getting the average of everyone's best ideas. What if there's nobody out there with any ideas? I know it's a little bit of a philosophical question, but yeah, it would be a very strange world, and the market would be very, very strange and work very differently if everyone invests passively. Because who then is the arbiter of what is actually worth something? So yeah, I mean, active managers, as I said, there's been this huge reduction. So we'll see what happens. I think the worry is that that's going to introduce new risk and new things into the market. I like this. Howie says, do you think that there are shades of passiveness? Would you consider a thematic index tracking fund more active than a broad market index? Which products exist on the edge of the spectrum? Okay, that's a really, really good question. We're getting really good questions today, which is good. It's keeping me, with it and awake. I've had meetings since 7:30 till now. So, yeah. That's a lot. Okay, so let's talk about shades of passiveness. Technically, what is passive? Technically, passive is that nobody is making decisions on what to put in an index, and you're just following the index. Now, the question is, what is that index you are following? Because there are some indexes that are completely passive, and there's a rule set that defines what goes in there. So the ASX 200, 200 biggest companies in Australia, S&P 500, 500 biggest companies in the US, Russell 3000, 3,000 biggest companies in the US. Like, there's a lot of indexes, these broad indexes, that are following simple rules like that. And what determines that? Well, it determines the value of the companies. Then there are a bunch of screwy indexes. And the funny thing is, one of the screwiest indexes is one of the oldest ones, the Dow Jones Industrial Average. So the Dow Jones Industrial Average is 30 companies. And everything about the Dow is screwy, and it's crazy that it's actually still talked about all the time, but people are just used to it. So the Dow Jones Industrial Average is picked by a committee and is the 30 most important companies in the US. Now, what is important? I have no idea. They, in theory, have some criteria that they don't really talk about, but the Dow has always been this weird anomaly. So running up into the tech bubble, everyone's saying that the Dow is out of out of touch because there aren't as many tech companies. So then they put a bunch of tech companies in it, and then it went down a lot. So the Dow is just literally picked by a group of people. The Dow is also not a market cap weighted index. It is a price weighted index, which is insane. What it basically means is that if I'm trying to make up two extreme examples. What's a small company? A small, insignificant company. Anyway, the whole point of this is that the price matters and dictates how much of a percentage of the index a company is. So if Microsoft shares were $100, and I'm trying to think of some small company without being too insulting, and Subway sandwich shop shares were $300, they would count 3 times more in the index movement than Microsoft. So it's insane, right? So it doesn't have anything to do with the importance of the company. Now, they say they're all important, but basically what drives that index are the most expensive shares. And we, as informed investors, know that the price of a share means nothing. What matters is the percentage, matters is the revenue, the earnings, everything else you're getting from the company. So the Dow Jones Industrial Average is an example of a really, really screwy index. Is that passive investing? I would say no, because there's a group of humans that are sitting there picking what goes in. They're influenced by everything else, that the way that the index is weighted is out of whack with reality. So yeah, there's a lot of passive funds, supposedly passive funds, that aren't that passive. Now, where you were talking about, Howie, is thematics. And if you want to hear what Shani described as a 30-minute rant by me, we did a podcast on thematics. Now, a thematic ETF is tracking an index. Those indexes are, I think we describe them as like the Frankenstein of indexes, where they sew all this weird stuff together, and it's technically an index, but it's hard to figure out the rules that's being governed. One of our favorite ones is the FANG index. So there's a FANG ETF that is tracking this. I don't even remember the name of the index. It is 10 companies. It is 10 companies that are large. They have some weird language around it, that a committee selects them for like large important companies that show like price momentum. So basically what that means at the end, within like the technology and communication space. So what that means is they are picking, if we translate that, finance BS into English, it means they are picking large companies that have gone up a lot in price. That's momentum. They've gone up a lot in price, and they're in hot sectors, technology, communications, et cetera. And there's something even there about like, they basically pick overvalued companies. So is that passive investing? Yeah, I don't think it is. So I think be very careful about sort of the bets that you are making. People think investing passively means that you're taking a market neutral position. Well, in theory you are, but also look at those indexes and what the constituents are. Even the wide variety index, or even the wide indexes, if you're investing in a global ETF, you're betting on the US, right? 65% of your money goes into the US. Is that a good or a bad thing? Well, I don't know in the future, but just know that that's what you're doing. Somebody just said, great webinars. That's nice. Let's see. Okay, so Eric has a good question, saying, is there a comparison of volatility between passive and active? So yeah, let's talk a little bit about volatility. So volatility, generally, there are different ways to measure volatility, right? You can measure just like pure volatility in terms of how much do markets in general bounce around. So volatility is price changes. Generally, the way that volatility is measured in comparison to overall market volatility, and we get that from beta. So what you can do is you can look at the beta, which will be published, of any fund or ETF. And that will give you the volatility of that fund or ETF compared to the overall market. So let me see if I can find a good example and bring this up. So what that means is that if you have a beta that is over 1, it is going to be more volatile than the overall market. So let me share my screen. All right, I don't even know why I'm not promoting that you buy this. I'm just looking at this thing. Okay, this is this famous FANG ETF that I was talking about, which is just ridiculous in almost every way. That's obviously a personal opinion. So yeah, if we sit there and we look at this FANG ETF, we can start looking at, well, why is this, of course, now not working? Okay, well, anyway, the beta is normally published right there. I don't know what's wrong with the website. My fault. But yeah, look at the beta. So then you can sit there and look at volatility. Now, what I will say about active funds that was a passive example. Active funds, you can get low vol funds. So go look at some of the active funds, or even what I would sort of consider active factor funds that are looking at quality. So Moat's one of them, things like that. You can look at some of those, and those will have lower volatility. So generally, value funds have lower volatility than growth. So if you are an investor that's looking to reduce the volatility in your portfolio, that can be a good thing to do. All right, Lisa of Alpaca fame. So she says, does investing in ETFs result in a higher return than investing in individual equities by avoiding management fees? Yeah, so it depends. So Lisa, you're talking about ETFs and individual equities. So if I invest in individual equities, in theory, well, not in theory, I have no management fees, right? If I buy an ETF and I hold it for 20 years, every single year I'm going to pay a certain percentage of that ETF in fees, so whatever fees are disclosed. If I buy individual equities and I hold an equity for 20 years, I pay nothing. There are no transaction costs after I've initially bought it. If I don't sell it, there are no taxes on it, except for tax on income. So yeah, there are no fees. If I invested in an ETF, a couple of things can happen. Number one, distributed capital gains can come to me. If that ETF manager is buying and selling things, they will distribute those capital gains to me. I'll of course pay the same income, same tax on income as I would if I owned all those constituents individually. So yeah, in theory, buying individual equities, having a portfolio of individual equities means that at the very least you have control over fee timing, whether you make a transaction, and you have control over most tax outcomes. Obviously, you have to pay for dividends that are paid to you, but you have control about capital gains. Now, that doesn't mean that you're actually going to beat the market if you're investing in a passive ETF, but yeah, in theory, the fees should be cheaper. Someone says, how long to hold an ETF? Well, that all depends. So I will say in general that we are proponents of long-term investing here at Morningstar. We believe transaction costs and all of the different things are associated with transaction costs. So that is bid-ask spread or buy-sell spread, whatever we call it here in Australia. That is potentially with an ETF, a premium or discount that you're paying. That is capital gains tax that you have to pay. All of these different things and the transaction costs in general. So all of those things are negative for investors. And we did, as part of this podcast, we're doing a little research into Robinhood. So Robinhood, of course, is the famous free trading platform in the US. And the last time they've stopped publishing their trade volumes, but the last time they did, and they've done it because basically this stuff is gambling, they know they're going to get regulated. The last time they published it, that's a personal opinion, the last time they published it in June of 2020, the average Robinhood customer had 7.2 trades a month. And these are tiny trades. They're also very low amounts because they're catering to a lot of younger investors. And through gamification and everything else they've done, they really encourage a lot of trading and just the fact that it's right. If you're trading 7.2 times every single month, it's very unlikely that you're going to do well over the long term. So yeah, we believe that you should hold things, whether it's an ETF or whether it's an individual share or a fund, we believe you should hold things for longer periods of time. So this is a good question by Fergus. On the range of passiveness / weirdness of indexes, where does something like the Van Eck Morningstar Wide Moat Index fit in? Okay, so yeah, let's talk about this Van Eck Morningstar Wide Moat Index. So Morningstar does have indexes. We sell those indexes to third parties. We actually have two parts of our index business. One, we have a free index model where we're trying to we're basically trying to, in our opinion, do right by investors by releasing indexes that basically very closely replicate indexes that are known, so our US market index versus an S&P 500, because companies like S&P, for these wide-ranging indexes, make a lot of money off of basically the name of that index and selling those constituents, or selling the ability to use that index to companies that create things like funds and ETFs. We've got that side of our business. We've got another side of the business where we have factor-driven indexes that we sell that are used for products. So a good example of that is this VanEck Morningstar Wide Moat Index. So what is Wide Moat? So basically, Morningstar are equity analysts. Every company that they cover, 1,600 globally, they assign a moat rating to it. So wide moat, narrow moat, no moat. So wide moat, narrow moat are companies that we believe have a sustainable competitive advantage. 10 years for narrow moat, 20 years for wide moat. So sustainable competitive advantage means that we believe there's something inherent about that company that will allow them to basically, as a business, outperform other businesses, that they will either be able to have a higher margin, so they will be able to keep more of all the revenue that they generate, or we believe they'll be able to hold and grow a bigger market share, that's what their competitive advantage is, and that's the moat. So we sell an index made up of those wide moats to VanEck. So what I would consider this a factor index, and you can point out where you might think I'm wrong on this. We do not rate, obviously, our own ETFs that are based on Morningstar indexes because it's a conflict of interest, so I can't say what our analysts think about it. But I would consider this more of a factor ETF, basically a quality ETF using Moat as a proxy for quality. The problem that I have with some of these other indexes is, and Wide Moat is agnostic to the industry, to what's going on, what are the fads that are out there. What I would consider a thematic ETF is more of a marketing creation that is trying to basically market a fad. So that fad can be, there's a video game ETF, there is this battery technology ETF, which we sort of ripped apart in our podcast on thematic ETFs. These are all fads, and these are themes that resonate with investors. If you go back and look historically at these thematic ETFs, they are very, very short-lived. So basically, they're released by a lot of companies when that theme has been collectively decided by the market that this is something that's great. Once everybody has decided that, the investment thesis is probably over. You're probably way too late. So, that's obviously me on my soapbox a little bit, my own personal opinion. But I think there's a difference between something in a wide moat ETF, which is we've been rating stocks with wide moats for a very, very long time. Those are individual equity analysts that are looking at their own coverage. There's nobody masterminding this thing. We're just rolling it up and selling it. There are others besides this Morningstar one. I would say quality and low volatility ETFs, which are also factor ETFs, where I would say if you are an investor looking for something very specific out of an ETF, maybe that can help you achieve your goals, whereas some of these, what I consider more speculative thematic ETFs, do not. Yeah, so Dennis is asking, how often does the makeup of Dow companies change? Yeah, not that often, but go back and look. It is really interesting to go back and look at the Dow Jones constituents in 1999, kind of before the tech bubble, and now. And it is remarkably different if we go back and look at it. So it does change. It is the weirdest index out there, in my opinion. Okay. So, so Richard's saying, I have a strategy to invest in index funds for the long term with certain selling criteria. For instance, triple Qs, that's a NASDAQ, will reach certain bearish criteria. I'll sell 30% of the holdings, then keep investing it on a weekly basis. It could balance long-term investment method and short-term risk avoidance. Any comments or suggestions? Yeah, so what I would say is, I think what you're trying to say, Richard, and obviously study after study has proved this, that as investors, we are obviously emotional beings, and we make very poor investing decisions, basically because particularly at times when we shouldn't, So it may not be every day, but particularly times of market excess, when we're in a bubble, everyone piles in. And when the market's doing really poorly, everybody piles out. So I do, agree with you that knowing that we are sort of hardwired to make poor investing decisions as individuals, that a lot of people said, okay, well, I'm going to set up a formula. And this formula is going to remove the emotion from investing, and that will ultimately make me a better investor. So yeah, it's hard for me, obviously, to comment on your particular strategy, but I do know that, yeah, I think you're trying to solve a very common problem that investors have. The only thing I would say about sort of what you're doing, so the short midterm risk avoidance is, yeah, just be careful how short-term of a period you're looking at. So obviously, if you're trading every week, there are transaction costs, capital gains, everything else involved in that. And, sometimes maybe it's focusing too much on sort of short-term movements versus holistically what's happening in the market. But yeah, you're certainly identified and trying to solve a problem. So Price put Berkshire Hathaway into the Dow. Okay, so Berkshire Hathaway would break the Dow, right? Like there is no way that they could put Berkshire into the Dow without changing their formula, right? So at the end of the day, I don't even know what an A share is trading for now. But basically, Berkshire Hathaway famously has not split. So it must be somewhere, I can look it up, it must be somewhere like around $100,000 now. So that literally could not, 420,000. Okay, I'm way off. Yeah, so $420,000. So that would not fit into the Dow because it would make up 99.99% of the Dow. Right? So yeah, that's an example of where this wacky methodology of how the index works, where it's based on price, which has nothing to do with anything other than the fact that Warren Buffett doesn't want to split his shares, which is completely fine. Yeah. It's crazy. And if we think about Paul, if we think about just like the way that the Dow is constituted anyway, if I'm a company and I split, so I do a 4-for-1 share split. So I'm $100, all of a sudden there's 4 times more shares, I'm $25 a share. In a market cap weighted index, nothing would happen. I would make up the exact same part of the index because I am the exact same company. Nothing has changed. In the Dow, I would be worth a fourth less. I'd be worth a fourth less in terms of my influence on the overall index. So it's crazy and stupid, and I don't even know why it's around anymore. But yeah, it's interesting. All right, what else? We've got a couple more questions and 5 more minutes. Okay, so John is, so we've got a question from John saying, I'm invested in Aussie Biotech. The share price is being held down, I believe, by a hedge fund investor, robo-trading, no doubt, for their own benefit. This is very effective controlling the share price. It's possible for an individual investor to compete with. Yeah, I mean, there's, listen, when we start looking at kind of market manipulation and things like that, is that, hey, if you are a large institution, if you're a hedge fund, right, you're investing in, I assume this biotech, John, that you're in is probably a relatively small company. If you have a big sum of money, of course, you can manipulate that stock price. The hope is, I would hope, is that over the long term, eventually that biotech will actually reflect the value of the company. But yeah, there are certainly things that investors can do to manipulate share prices. And if you don't think individual investors can do it, start looking at some of these meme stocks in the US, whether it's GameStop, AMC, things like that. Like I don't know anybody in their right mind that thinks that those stocks accurately reflect the value of basically failing companies. So, I have the same people sitting there and telling me that like Netflix is a great stock to invest in, as is AMC. And I'm like, well, yeah, they're kind of opposite, right? They're sitting on my couch and watching something, going to the theater. I don't think they're both going to work. But yeah, anyway, that's my 2 cents. Look at you, Shawnee, throwing stuff out there. I like your comment, Paul. Dow's pointless. Why not index just for companies investing in A? Well, hey, you do okay, right? You have Alphabet, Amazon. Maybe that's the way to go. So yeah, someone should do a study on that. Okay, we've got time for a couple more questions. Let's see. Yeah, so Bill is saying there's a lot of diversity and performance among active funds investing in the same sector. To report on the variability between individual active fund managers. Okay, so we don't really that is a good point. Like we could do that. I don't believe there's anything that I've seen that's looked at that variability. What we do is we do a couple of different things in terms of ratings. So what we're trying to look for and what our analysts, how they rate funds and ETFs, is they're using medalist ratings, which are forward-looking ratings. So what we're trying to do is look at everything around. We had that Tom Cruise picture at the beginning. Everything generally that you see around funds and ETFs is backwards looking because it's looking at performance. So what our analysts are trying to do is they're trying to meet with the teams that are managing these funds and ETFs, look at the companies that they work for, certainly look at the price of these things, look at the process that they're going through, the investment process, and determine funds and ETFs that they believe will outperform in the future. So that's sort of our attempt at forward looking. But yeah, no, it's a good point that you can look at certain variabilities as well. Okay, well, I think we're going to stop this here because there's only 3 minutes left, so I can have a glass of water before we have our podcast recording. But thank you guys for attending. So we're off on Thursday, maybe. I'm supposed to go to Hamilton Island. What'd you say? Well, no, that's why I'm saying that we're not doing this on Thursday because I'm supposed to go to Hamilton. But obviously, if the case numbers today in Sydney, we will see what happens. But back next Tuesday, and we're talking Bubbleville, which I hope will be interesting. So I wrote some articles on what I called Bubbleville. And basically, we're going to look at some of the speculative excess in the market right now and how that may impact more conservative investors. An hour rant, says Shani. She will be excited to be here. So thank you guys for joining. And if you want to read the articles, Google Morningstar Bubbleville. You can read about them first so that I can cut short the rant. But thank you guys very much. And I'm available for any questions, mark.lamonica1@morningstar.com. Great, thank you.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.